Well, let's get more on this emerging market story from Daniel Tenengauzer. He's the head of Global Emerging Markets Fixed Income Strategy at Bank of America Merrill Lynch Global Market Research. Thanks a lot for coming in. Appreciate it. So you just heard about what Mark Mobius thinks. Where do you stand in this whole debate on China and whether it is indeed getting overheated?
At this stage, we don't think that we're quite there in China. Clearly, they are adjusting. They have been tightening policy so far this year, and it's been surprising to us and the market how quickly they have moved in several areas to tighten monetary policy. But we don't think that the imbalances are quite there yet.
So what about how it stands as an opportunity for investors on the fixed income side? Because Mobius was talking more about equities.
Yeah, that's correct. I mean, on the fixed income side, we believe that, first of all, the curve is very, very steep. We don't, again, because we don't think that they are overheating so quickly, we don't think that the PBOC, that's the Central Bank of China, will be tightening monetary policy as much as priced in. And as a result, liquidity may stay there for quite some time, which will be overall supportive for fixed income markets. On the other hand, for Brazil, which was the topic of the discussion, we think that real interest rates are way too high. So it's quite the opposite. We think that in Brazil there is more room to cut interest rates. So
not looking there as a fixed income opportunity?
No, it is, but a different type of opportunity. We think that Brazil is more of a long-term story, with basically the Central Bank of Brazil sustaining lower real interest rates than what's priced in for the next 5 to 10 years, whereas China is more of an immediate story where rates will likely stay low for the next few months.
Now, I also want to ask you, I know you watch, of course, the Forex market closely. Paul McCulley of PIMCO today becoming the latest investor to talk about the dollar and that it may indeed start to improve more sharply. Do you agree, and what is that going to mean for then other currencies?
First of all, yes, we do agree. Second of all, we believe that there are two stories for the dollar. There is the one story of the dollar as an expensive currency against the emerging markets, but there is also a dollar against the rest of the G10. And from that perspective, we think that the euro is too high. We think that a number of G10 currencies are too expensive against the dollar.
Well, specifically, McCulley was also talking about, he highlighted the Canadian, Australian, and New Zealand dollars as being attractive because they are primarily commodity currencies, seen as commodity currencies. And obviously, he thinks that commodities are going to do pretty well here. Are those opportunities, do you think?
That's correct. That's exactly right. The story is you need to divide between countries that can generate and will generate domestic demand as a result of what's happening in emerging markets. Those are commodity currencies within G10 and the rest of emerging markets as well. Those currencies should do well against the other block of currencies where we believe that deleveraging will prevail. So that's Europe and Japan.
And, you know, as this perception grows that the dollar is going to continue to strengthen, and that does seem to be pretty broad at this point, how then do you make money when you're looking at other types of markets when maybe it's a trade that's going to get crowded?
Well, that's correct. First of all, one way to look at it is not necessarily selling the dollar against emerging currencies, but selling baskets. Okay, so selling euros, selling dollars, selling the Japanese yen, and buying emerging markets, buying the Canadian dollar. Those are the ideas that we're trying to push and put in front of our clients.
I have to ask you about Greece as well. Not necessarily emerging market per se, is in the Eurozone. Do you see other crises of the sort that Greece experienced emerging elsewhere?
Any big imbalances will clearly appear as we move towards tighter monetary policies around the world, right? The Fed has clearly changed stance over the past few months. They haven't hiked interest rates. We don't expect them to hike until January of next year. The same goes for the ECB. But as liquidity starts to be drained out of the system, we'll see those imbalances appearing. Clearly, Greece was one of them. There are a number of emerging markets where imbalances still persist, but we think this is mainly a story for European periphery.
And so you don't think we'll see anything in the magnitude as we've seen in Greece necessarily?
There aren't as big imbalances in emerging markets. All those were really corrected a year ago.
Now, do you look at Greece? Because there was, of course, the debt sale today, and I'm curious your reaction to it.
Well, I mean, we're seeing Greece, the main hump for Greece will happen between April and June of this year. So that's when we'll really be watching those debt sales and the issuance over there. The rollover really changes dramatically during those 3 months. Until then, we don't believe that the issuance will be as important.
Okay, Danny Tenengauzer, thanks a lot for coming in to talk to us. Appreciate it.